I'm Isaac Schwartz. Thank you for taking the time to join us in this format. I've been an investor for 20 years, most of that time with Robotti. I started Robotti Global Fund in 2007. And every year I look forward to seeing our partners at this annual presentation. But this time I'm going to need to make do with just you seeing me. This year, my colleague Theo Vandermeer joins me. Theo and I have worked together for 8 years. He's visited companies with me around the world. And he and I always have a spirited dialogue about investments. So we'd like to bring that to you today. And we hope you'll also submit your own questions too. And we'll have a broad discussion. My origins as a global investor start in 2005 when we were buying Thai and Southeast Asian stocks. And since that time, I lived for the better part of a decade in Hong Kong and Singapore, and even had extended stays in Beijing and Istanbul, and traveled extensively, visiting more than 1,000 companies in Asia and Europe over the years. I describe my style of value investing as flexible and focused. And today we'll get into what I mean by that. It's important because the principle affects idea generation and also risk management. And it's why our portfolio is defined by a unique set of characteristics, not market cap or a certain geography. We're looking for good risk-adjusted returns across developed and emerging markets, and even seamlessly comparing ideas across them. So with that, we should dive in. We will start having our own discussion about how the fund is positioned and some of our investments and approach. And we will also discuss what you would like to discuss.
Great. Thanks, Isaac. Yeah, again, we want this to be a conversation, and hopefully the one that Isaac and I have during this meeting will engender a bunch of questions from you all. But we'll dive straight in. And I think a good starting spot would be to discuss the largest position in your fund, which is Ocado. And I think that it's an important one to talk about right now because over the last 9 months, due to COVID-19, people have gotten a lot more used to ordering things online, especially ordering food and groceries online. And I'm wondering if you can talk about the growth that Ocado has experienced, largely due to the coronavirus and the stay-at-home orders and everything that's come from that.
Well, I think it'd be great to start talking about Ocado and COVID. Ocado is a logistics technology company that supports the global grocery industry. Specifically, it enables grocers to deliver an excellent e-commerce product to their customers and do it profitably. I do not see Ocado as being especially COVID related. I see companies like Instacart, companies that are related to a sudden shift that the society has undergone this year that's temporary. Ocado is a company that we've been investing in for several years, been interested in for several more beyond that. And Ocado is at the vanguard of what a number of companies are doing, which is to help the global food service industry shift to a better inventory management, to a better system of inventory management. Ocado builds massive centralized warehouses that are also robotically automated. But the real key is they build centralized warehouses. So they operate their largest grocers are the largest single location grocery stores in the world. This enables reduced food waste. Waste is a significant cost to grocers. This enables a much higher inventory turnover. So this is So it's not a company that I see as overly COVID related. That said, all e-commerce businesses in this year got very significant marketing benefits, had temporarily lowered customer acquisition costs, and they did benefit from that. And so a new and higher baseline of demand has been set.
Mm. So it sounds like, if I'm understanding correctly, that you're saying that there were a bunch of companies that got maybe temporary growth boosts from COVID due to the stay-at-home orders and the lockdowns, and that what you're seeing in Ocado is more of an acceleration of a sustained growth that was probably already going to happen, and it's just maybe been accelerated, and so now the floor for the continued growth is a little bit higher. Is that fair?
Absolutely. The companies that I see as having had temporary growth are ones whose core value proposition is just based around customer convenience. Centralized grocery distribution, that is an ancillary, that is a secondary benefit. Mm-hmm. The core value proposition is about the inventory management and about the lower costs that brings to the overall supply chain. So it drives freshness, it drives lower costs through having a more abbreviated supply chain to compensate.
Right. And so I guess the other thing that I want to talk about, you mentioned Instacart, and I think that for people who live in New York and on the East Coast, people are probably more familiar with companies like Instacart and Fresh Direct. And can you just kind of describe where Ocado falls into the broader industry overall?
Sure. Instacart is a gig economy company. So Instacart is based on retrofitting existing infrastructure in the world. Instacart is a bit of a bourgeois conceit that in big rich cities you can find someone to pay to get groceries, but ultimately it's just putting a layer of cost onto existing infrastructure. Ocado is more like an innovator's dilemma. The Clay Christensen book is more of an innovator's dilemma champ, in that Ocado is building new infrastructure that is far more efficient, and that's why, when we started investing in the company 3 years ago, it was just in the UK, where it had been for almost 2 decades, and we were buying it as an extremely efficient UK retail business with fantastic customer cohorts, with very high net retention of revenue. So, even if they cut their marketing, they provided such a good service that they would continue to grow. And then in the ensuing years, they've gone into France, Canada. They are imminently launching in the US in a number of cities, in Orlando, Cincinnati, Dallas. And they're extending even further around the world. They've been in Canada for less than a year. In Toronto, they're in the Toronto metro area. You can use Ocado. Mm-hmm. And since that facility went operational, the grocer for whom they built it there, Sobeys, has announced that they're working on 2 more facilities in Montreal and Calgary. Mm-hmm. So, Ocado took their excellence at creating a really profitable solution, as opposed to Instacart, which more took a stopgap measure, which took a way to make sure that grocers that are not ready to serve customers in that comprehensive way can at least have some e-commerce offering.
Gotcha. So it sounds like what you're saying is that
this is the biggest category of retail. Half of all retail is grocery. So we just see enormous potential, and I believe that because things have changed in the last decade in such a significant way for the company, I still think in a lot of ways the market is looking at their core business in a critical way, and really not taking any optionality into account from all these other businesses that they're developing. They're refining the core product that they provide to grocers in new and interesting ways, and then they're going into so many different geographies that offer even higher potential than their home market.
So yeah, it sounds like what you're saying is that like Instacart is more of a price arbitrage on labor, or a labor price arbitrage, whereas Ocado is actually adding efficiencies into the market. And so over time, that should help Ocado, grow margins and also just grow the business as well, because they're actually adding more efficiencies to the market. I just want to remind everyone again to please continue asking questions, but maybe we should move on to another company right now. Just because when I look at your portfolio here, Hong Kong Television kind of jumps out at me because I see a lot of similarities between that and Ocado. And I'm curious, is that just an extension of your investment in Ocado, or are there really distinct things to Hong Kong Television that attracted you?
Well, Hong Kong Television, despite the name, it is not a media company. It's not a TV group. It is sort of the Ocado of Hong Kong. It's the leading online grocer in the SAR. And so, in that regard, it did come to us, as an extension of the Ocado investment. But Hong Kong has very special attributes, and the company has a special position in e-commerce in Hong Kong. And so, I lived in Hong Kong for 5 years, and am in very regular contact with a lot of friends and business people there. And when you look at the e-commerce landscape there, it's a unique place because it's cut off from China. There are about 8 borders between China and Hong Kong, and e-commerce has developed in a different sort of a way. And Hong Kong Television, which gets its name because it's the entrepreneur that controls the group, was originally in the telecom industry in the 90s. Then there was a sort of a David and Goliath battle against the Hong Kong government to try to get a TV license, which ultimately failed, but which got a lot of coverage, and that's where they got the name from, and they kept the name. And then they finally, close to a decade ago, decided to go into this, automated warehouse and to be ahead of the curve in e-commerce. Since that time, they've done very interesting things in their home market. They've developed their own payment solutions. Recently, a major retailer in Hong Kong, Giordano, sort of like the Gap of Hong Kong, started to accept HKTV Pay in all physical locations and online. If that payment processing division takes off, that's a really interesting adjacency that we'll see what it could become. They've also started to look. The management of HKTV it knows Ocado really well and admires the company, and they've started to look at similar Southeast Asian markets, whether they could bring their solution to places like Bangkok or Kuala Lumpur that have similar affluence, density, and large size. So I guess HKTV is definitely very it's inspired in certain ways by Ocado, but it's a different. But it also has some unique attributes being there in Hong Kong.
Mm-hmm. So one of the things you mentioned there was the David and Goliath aspect of Hong Kong Television, and that kind of surprisingly reminds me of your investment with Spotify, which in a lot of ways is also a David and Goliath story. And it seems kind of strange to say that with how well known and how large Spotify is, that it's kind of the David in that story, going up against Amazon Music and Apple Music. and largely beating them out and becoming the number one audio streaming platform in the world. And so I'm wondering if you can talk about what led you to your initial investment in Spotify and kind of where you see it positioned today.
Spotify is I would say is a double David and Goliath, because it's Spotify against Apple Music, Amazon Music, and then it's just the music streaming industry versus big music and the established way that the music industry operated. Yeah, it's interesting actually to think about all of these, all the companies we've been talking about today have some element of that. Spotify is a company that I got interested in it really more recently. I looked at it when it went public a few years ago. It went public about 3 years ago, and I had been a very happy customer for many years, but it didn't jump out at me as an investment case initially. But in the couple of years after the IPO, the company performed extremely strongly, but the stock really did not follow, and it sort of piqued my interest. And then, looking into it, it shared a lot of elements that are appealing in many investments. I was able to establish a feeling that there was very impressive capital allocation going on at the company, and there's been a very interesting investment program, both capital investment as well as operating expense investment. Including, they made about half a dozen investments in the podcasting industry that were very interesting. Another thing that appealed to me about the business was sort of being a one-off, widowed in a way, as it were. Spotify does not come from Silicon Valley. It comes from Stockholm. It's an extremely global business. They have 350 million customers, quite evenly spread all over the world, emerging markets, developed markets, just not in mainland China. So about 1 in 20 people outside of China all over the world use Spotify. And when I saw how they were performing, I started to take a bit of a deeper dive. And that was kind of the initial trigger with Spotify, Theo.
So you mentioned podcasts, which is actually something I've seen in the news more with relation to Spotify and some of the big names that they've attracted, and Michelle Obama and Joe Rogan, and it seems like that's a real focus for them going forward. Can you speak to how you see them positioning themselves in that space?
Yeah, I wouldn't call those big names. Michelle Obama and Joe Rogan are like the most elite cultural influencers on the planet, and Spotify has signed multi-year exclusive deals to distribute their content. So, it reminds me a little bit of 15 years ago when Sirius signed Howard Stern exclusively. Joe Rogan is sort of like the modern Howard Stern. These investments that they've made put them firmly in a position to be the most dominant player in sound streaming. So podcasting is one of the things that initially caught our eye about Spotify. In the last month, more than 100 million Americans have listened to a podcast. So it is a full phenomenon that's here to stay, with 1 in 3 people listening. But but as an industry, it's in the early days still of its trajectory. So the monetization of podcasting relative to say the radio industry, radio generates something like 10 times the revenues per hour listened of what podcasting does. It's really a white space, I would say.
Mm-hmm. That's kind of surprising to me, based on, if you're only getting 10% of the fees for the marketing on podcasts, it seems like that's a much more directed advertising than, just broadly putting it on FM or AM radio. Spotify knows who I am; they know my age demographic, so it's surprising to me that there's that much of a price difference there.
Well, absolutely. I mean, it reminds me a little bit of the early days of the internet 20 years ago, when it was very cheap buy ads on the internet, but everyone was like just sort of figuring out how to track the efficacy and who was actually seeing the ads and all that stuff. Mm-hmm. I mean, as you mentioned, Spotify has a ton of data on its users, and the ability to use that to help support the end customer, so that we hear ads that are relevant to us, so they're not such annoying ads. That supports advertisers, so they're advertising in an effective format. I mean, one thing that interests me about the company is that, so I mentioned they have 350 million users, and they have basically two products, and it's almost 50-50. They have paid users and free users. It's slightly more free than paid users, and the only difference is that free users have to hear more ads than paid users who have very little ads. What's interesting is the average user across the two products uses the service for around 40 hours a month. So I mean, if we all think for a minute, think of your phone and think of the different apps that you use, messaging, email, internet. To be using an app for 40 hours a month is an incredibly personal relationship to have with that service, and so I think that presents really interesting opportunities in terms of them knowing the customer so well, so serving the customer really well. I think that they would have a lot of ability to increase the price of the products if they want to, but I think that that's not their main focus. Mm-hmm. So I see a lot of opportunity in many different areas of it, in music streaming and in podcasting, in changing the advertising proposition. And in the meantime, they offer a great product across both products. So they're expanding the user universe.
Great. So we actually have a couple questions here relating to Spotify. So I want to kind of dive into these. So one of the participants is wondering if you have any thoughts on the recent Bob Dylan deal and any future similar ones that you might see coming up.
So the Bob Dylan deal is what's happening. First of all, people are speculating that the family wants to sell it because of the tax code or something. But so that's going to the music license or the library. In that case, I believe it's Universal Music Group that purchased the library for like $300 million or something. Makes me wonder, is Taylor Swift's library worth like God knows how much? That will not have the issue for Spotify is more signing the master contracts with the libraries. So, for example, recently, something I think was very quite visionary, but in the last 18 months, Spotify has licensed the two most comprehensive Indian music libraries from old music groups in the subcontinent. They're by far the leader in that market. They have a very, very big vision for that market. And it just means that a customer wanting to hear anything would have that available to them. But in the case of the Dylan deal, that more changes the royalty structure, the music, and does not really affect. It doesn't help or hurt Spotify.
Mm-hmm. Right. So another question we have here is kind of pertaining to everything we've talked about today. So the question is, Ocado, Spotify, and Hong Kong Television are all not currently cash flow positive, and they're wondering if you can talk about the holdings that are profitable right now. And maybe actually just to add on to this question, before you talk about that, do you want to briefly talk about maybe some of the valuation that you think of for those three companies?
Okay. So first of all, just to clarify, Ocado and Hong Kong Television are very profitable. Hong Kong Television has never been profitable prior to this year, but they had been growing revenues very significantly for many years, and last year they did about $360 million in e-commerce revenues, and my estimate for 2020 is that they'll do about $800 million for the full year, and they've already given an update to their earnings guidance as a Hong Kong exchange filing, that they will earn more than $25 million this year, which is a swing from losses in prior years. That's a great example. That's a great example of a company where I think so the Hong Kong retailing market is around $100 billion retail market. Hong Kong Television is mostly half in grocery and is in a number of other categories. That's another difference between Ocado and Hong Kong Television. Hong Kong Television, because of the small size of Hong Kong, pursued to become just the overall leader in e-commerce there. This is a pretty extraordinary thing, that they are far and away the largest. I think they have about one in four Hong Kongers used the service in the last 12 months. So they have, and anyway, everybody knows and uses HKTV and sees the vans driving around. But they're less than 1% of the retailing in the city, being by far the largest company. So at $1.5 billion market cap, and seeing the layers of leverage to their earnings model, in particular the logistics model that they've built, with absolute best in class warehousing, vans. I think the company is more, the market cap is very modest. Thinking that they'll revert back to growth rates of past years, to much lower growth rates than this year. They're going to be able to drive significant earnings growth, and then if any of these other things they're working on, I mentioned their payment processing. They've developed credit card partnerships. They've looked at going into I should say they've beta launched a restaurant food delivery product in Hong Kong, modeled after Uber Eats, Deliveroo. If any of those are effective, I mean, it's going to be hugely incremental. I think there are a lot of very successful e-commerce companies, Mercado Libre, Shopee, Amazon, that have far lower levels of profitability. I think it's sort of remarkably inexpensive, given the moat that they've built, and therefore the sort of clear trajectory. Mm-hmm. I guess to talk about to talk about valuation on Ocado for a minute. So Ocado has been has been free cash flow positive, basically for 20 years. They were a doubly cursed birth in a certain regard. One being formed right at the tail end of the internet bubble, and the locking off of capital that caused. Although it also caused some advantages, it reduced some competition in the early years, and coming again not from Silicon Valley where there are endless checks to be written, but from the UK, and they've been public for 10 years. They've been extremely capital efficient in their growth, building up in their home market to an over $3 billion revenue business this year, with very significant profitability. On a blended basis, the company, it looks like they run a loss in what is their largest division now going forward, which is their international OSP solutions group, Ocado Solutions Platform. And so that's because they are spending money to build warehouses in 6 countries outside of the UK: US, Canada, France, Sweden, Australia, Japan. And they only take in revenues from operating facilities, and they have facilities operating in Canada and France, and they're building more facilities in both of those markets than they have. We track customer experience through a variety of channels. I've cultivated relationships with people in the grocery industry, especially in France, to get feedback on the take up in that service. Then I also have friends in Paris and family in Toronto, and everybody is using the brand of the service is called Monoprix Plus in Paris, and Voila in Toronto. And the excellence of the service has gotten an enormous response. So the dollars that they are investing there are very well allocated capital that are going to generate very high returns. They have spent capital in that manner over a very protracted period of time in their home market, and so they've seen what happens when you build. Later on, I should when I've been in the facilities, they don't like when they open them to guests, they don't like you to take pictures, but there are some videos online, like from The Economist and a couple of other sources. I can Business Insider. I can share them with any partners who are interested. But the key is that the facilities have a huge upfront capital cost because they have extremely advanced robotic technology, so that they can basically, all the global facilities are being run out of their headquarters in England. So the facilities they have, in Orlando and Dallas will be run out of like a control center. And of course that means, a very high upfront capital cost, but then a very high fixed cost base that has a lot of very high levels of operating leverage.
So it sounds like you're using specific metrics when you think about valuation for these companies on the core business, and then looking to kind of see what kind of free options they might have on top of that as a way of further growth. But you're looking at these specific metrics for the core business, and then these options that come on top of that.
I mean, to be specific, in the case of Ocado, I believe that off of the existing business that they've built, the company is selling on a single-digit PE of a few years out from delivering on these existing contracts, and that's why, the stock is significantly higher than when we invested 3 years ago. And I've had to make an active decision to invest more in it. And that's because from my understanding, two things have happened. The risk has declined, and the profit opportunities have increased. So I actually think that I think it's a much less risky proposition as an investment now at a higher price than it was a few years ago, and that's because that's because of the business that they're building. So it wasn't. We have other investments in the portfolio. I don't know if Theo's monitoring
I guess that kind of.
Theo's been monitoring the questions a little bit more. Yeah. I'll look at them in a moment too. But a company like Penn that we've spoken about many times over the years, I look at that a little bit more reverting to mean, and so we would also want to see the valuation grow. If the price expands, then we might revisit that and sell it.
So I guess going to the second part of the question about where else you're invested that are maybe in the more traditional valuation metrics, and if there is anything that you own that's more in that. So maybe you want to talk about, does Halik Bank fit into that, or something that's more?
Well, I want to be clear. I can certainly be wrong about Hong Kong television, but it's very much in the traditional value metrics. It's just on every Halik Bank and Hong Kong television. Now they trade at different PE ratios based on 2020 earnings, but they don't trade at they both trade at very, very low valuations relative to discounted cash flow. Now in either case, the reason we build a portfolio and the reason why I tend to have, I am not shy from concentrating when I have conviction, and the best way to have conviction is in situations where I've been an investor in a company for long enough that I know mid-level employees. You don't only want to know the managements. Where I know I love to know former employees is often even better. But then of course things are dynamic and change. Theo, you've been with me to Kazakhstan, and you've met the management of Halik Bank also. A very impressive organization, but that's they've been a COVID loser. And they've been a COVID loser because in decline in industrial processes that's led to lower energy prices during COVID has had a hit to Kazakhstan's economy, and they are a general retail bank, so they're not financing Chevron's projects in northwestern Kazakhstan, but a slowdown in important industries, just like we'll see what happens to our beloved New York with slowdowns in certain industries as a result of COVID, and what that'll mean for commercial real estate, for lots of things. So, but again, I do believe that in the case of Halik that you mentioned, selling below book and selling around at less than 5 times 2020 earnings. I thought it was going to earn even more this year. The earnings are down a little bit. Namely, they went up in local currency and the currency went down. And I think that more than compensates for the risk.
Gotcha. So another question about Ocado, going back to that for a second, is we have a participant who's asking about the Ocado lawsuit and what your thoughts are about that.
So Ocado has been sued by a Norwegian company owned by, actually recently bought by Thomas H. Lee Partners, the private equity firm I think is in Boston. I have spoken to a number of experts on this lawsuit, and I actually think the lawsuit is going to have no effect in the end. But it appears to me that the absolute worst case from the lawsuit is a slight diminishing of the long-term profitability of the company, because they could be forced to pay a royalty to their to this company that they bought some of the warehousing technology from. So I think likely it will have no effect, and it may have a small effect.
Gotcha. So another question is pertaining to unit economics and how you think about that, specifically with unit economics and IRRs for the buildings of the warehouses, the building of the warehouses for both Ocado and Hong Kong Television.
Well, there's the unit economics of the customer served, and then there's the
Yes, I think the question is getting at both those things. So what's the payback period essentially for one of these warehouses, and then what's the specific unit economics that they can drive from a new warehouse to the end users that they're going to have from it.
Okay, so yeah, let's talk about
So I guess first, maybe let's talk about the payback period for the warehouses, and then we can talk about unit economics second.
So the payback periods that they've had on the large warehouses that they've built in England have been in the 4 to 5 year range, and that's over the last 5 years. They're onto their third warehouse constructed. I believe, and the company has been sanguine about leading too much information. I believe the payback periods are far higher on the warehouses that they're building in all these other markets, and the reason is because in every single
higher,
market,
do you mean quicker, or
a much quicker payback period when they build a warehouse for Casino Group in France and Kroger in the US. So in each of these, and Aeon in Japan, so in each of the markets, they have an exclusive relationship with a number 1 or number 2 grocer, and the grocer maintains the exclusivity by contracting to purchase enough of the warehouses and of the management of the warehouses, which are done on management contracts. And I believe the payback periods are very high in this case, and that's because the payback period is a little more complicated in these international partnerships, which are the future of the company. That's because Ocado UK decided to have a dedicated architecture from 20 years ago, where they said, how can we sell customers groceries online? How can we do it so that the customers love us and we get the best we get the best customer scores, and so we do it profitably. In the case of coming into the US to serve Kroger, there are different dynamics, because as you said, some people are using Instacart, and there are hybrid models. Walmart is the largest grocer in the country. Kroger is the second largest grocer, and of course Walmart has done some very innovative things. For example, with pickup and collect, which is a model that Kroger will be doing with Ocado as well. And of course, is a model that makes sense in a lot of the country where people are commuting, and then you can, if it's on the way, you can stop off and you don't have to go in for a half hour and park and everything. That changes the profitability metrics of the facilities, because the facilities are being integrated into an existing base of business. Kroger is a $140 billion sales business. Some of that's gasoline stations. So, Kroger, say, is a maybe $125, $130 billion business. And so, this is allowing them to serve their customers online and to do it profitably. A lot of grocers have options to serve customers online, but it isn't profitable, and the grocer feels cornered, particularly in a year like COVID, the grocer feels they must offer something, or otherwise they're going to alienate the customer. And so instead they say, okay, well, I don't quite know how to do this, so either I'll outsource it to someone else, or I'll have some sort of an internal stopgap. So in answer to that question about what are the payback periods, I believe that the payback periods are much higher. Like, I believe the payback periods are twice as fast with these, because it is such a big base of business, and it is so urgent for these clients to be able to move it online, and so to do it serviced by someone who's been doing that for 20 years. Now, when you talk about unit economics, do you want to, is it a general question about?
I think it's a general question specific to Ocado and Hong Kong television. And I guess there are a couple ways we can interpret this question, but it could be about, the unit economics of a bag of groceries, how much one bag of groceries generates, or a customer base. And I think probably for these, it's more important to talk about the unit economics per bag of groceries, or per SKU, or I'll leave it to you to decide which metric matters more, but I think that's the more relevant unit economics.
Yeah, either of these companies are perfect examples of that. So the last major scale facility that Hong Kong Television built was in 2018. And as I mentioned, the first year that they've been profitable is this year. The business grew very significantly. I think it increased. I think revenues were up about 70% from 2019 to 2018, and they were up by more than 100% in this year. And they swung to a profit in this year. And the unit economics are affected by two very important things that are very distinct. One is the usage of the facility, the warehousing technology, and driving volume through that to make the most use out of, as we've said, a very expensive upfront capital investment. The other side is delivery density, and these companies that are at the forefront of all this, that are determined to be e-commerce only leaders, they care about a full end-to-end experience. And I want to talk about delivery density I want to make a point about delivery density in terms of unit economics, but also a sort of acute point to come back to the name of Hong Kong Television. It was trying to be a TV station. It did not become that, but it's a bit of a leader in terms of innovative marketing and live streaming of live streaming sales technique. And that's because they have some legacy TV studios that they've converted into using for e-commerce, and how do you make the best use of that? But in terms of delivery density, that's an incredibly important part of the unit economics, and that really needs to be that needs to be done with electric focus, because if you figure out the right way to make the best use of all your fixed assets, of your drivers, and of course these companies are also figuring out what to do when driverless comes along, which obviously is several years out.
A whole other ballgame, yeah. So we have two questions here that are kind of similar. I'm going to try and combine them, but it has to do with, the participant notes that you have traveled extensively throughout your career, living in places. With COVID and the inability to travel as much, how do you get comfortable in unfamiliar markets today? And has COVID affected your ability to, meet with managements and do your research process?
Unfamiliar markets and research process. So first of all, being flexible and focused. The second part is focused. We are not in unfamiliar markets. So things that might sound like unfamiliar markets because they're, exotic, Turkey, Indonesia. We don't currently have investments in Turkey, but we have in the past and we will again. We do have significant investments in Indonesia. These are not unfamiliar markets, and there's been a very long gestation period of developing relationships and looking at a range of companies and having some requisite understanding of cultural and business practices, and that feeds into the research process. So first of all, I guess I have done some traveling this year. It's just Zoom and FaceTime traveling. But it is nice to keep up with people. But at the end of the day, a lot of a lot of the judgment comes in from from years of from having invested in these places for many years, and so COVID is a temporary halt to all that, and I mean I'm certainly looking forward to COVID. We're all looking forward to things going back to normal, but there are also some good lessons from COVID, which is that you can bug people when they're at home and it's acceptable, and then you don't always need to take an extra trip to have a management meeting in a far-flung location.
Yeah, and just to piggyback on that, I think that once things do get back to a sense of normalcy, that it's very likely that these two will complement each other well, the in-person travel as well as people's acceptance and digital acumen with doing things like Zoom. So I think it will be a benefit, especially going forward. So we are coming up on about an hour here, and I do want to respect everyone's time. I know we have a couple other questions here, so maybe I'll give you one more question and then we can wrap up with some closing remarks. And so this is actually a pretty good question to end on, but one of our participants is asking what makes you different from global fund managers and how you define global investing.
I think one thing that makes me different comes from years of living in emerging markets, living in developed markets, and all the travel, which is that I really am willing to compare investments across developed and emerging. That is not the that is not how I bucket things in my mind. I bucket things based on risk-adjusted return. Mm-hmm. And some years ago we had an investment in a small cap coffee chain in Thailand, and some years after that, in reference to the same company, we had an investment in Starbucks on NASDAQ, and they come together. So I do think that's a bit different, because I do think that many managers do like to be either developed or developing or Asia centric or EMEA or
mm-hmm.
So that is that is and the sort of market cap agnosticism.
Mm-hmm.
If I'm estimating an 8% forward CAGR on one thing, that may be better than a 15% forward CAGR on the other. It really depends on the importance of the company, its the resilience, and what I see as potential downside. So when we are willing to concentrate, and we concentrate in in mid caps in emerging markets and large caps in different parts of the world, when we are willing to concentrate, it's generally because we've found a special situation where there really is meaningful downside protection, since no matter how hard we work, no matter how careful we think we are. You know, we all make lots of mistakes, and but there should be that protection, and then there should be some state of the world in which, if things work out, there can be very significant upside.
Yeah. So again, one thing to add there is something that I've always respected about your process and how you invest is the gestation period you have before making an investment. I know with Ocado, that was something that you were aware of for 4 or 5 years before you made your initial investment. And I know you think the same way with geographies and yeah. And so I think that's a really important part of your process. Speaking to that is the places that you aren't invested, I think is kind of as impressive as the places you are, because you've done a lot of the legwork in some places that you know well, but you haven't yet made an investment because it's not ready for that yet. So I think that speaks well to how you formulate your entire portfolio. But
we will find lots of opportunities in different places where we have done work, but it is not necessarily manifest in the portfolio today. And yeah, you don't know when the opportunity arises. I mean, our biggest position for several years, starting in 2015, was a company that I had done a deep dive into in 2004. And it was in a market that we had never invested in. And then suddenly it became our largest investment, so 11 years later. And so, you know,
slowly and then all at once.
Period.
Yeah, so we are coming up on an hour. I want to thank everyone for joining, and also remind you all that you can always go to our website at advisors.robotti.com, and on there you'll find the RGF page, which will have all of Isaac's commentary, as well as our regular fact sheets that get uploaded there, and our blog. You can follow us on social media, on LinkedIn and things like that. But yeah, I want to thank you all for joining, and I'll hand it over to Isaac for some final comments. Isaac?
Thank you very much, Theo, for facilitating this. And yes, thank you everyone who tuned in. I hope I conveyed some of the passion that I have for putting together a portfolio of discrete risks, of really looking at misunderstood companies. I want to find opportunities where we're protected on the downside, but where the upside opportunity is very significant. And I am not trying to predict intra-year volatility. That's what we see in years like this. We see that in years like 2008 and 2011. I'm trying to find an underlying business that I can understand, that is cheaply valued, that is undervalued, and that we can hold for a few years and do well with. So we will have our quarterly opening at the end of this month. So we'll follow up with you about that. But anyway, I am looking forward to in a year when we will do this again at the Yale Club or our office, wherever, in person. In the meantime, thank you so much for your support. If there is anything that I can tell you about what we're doing, please get in touch at any time. And happy holidays.